Welcome to this lesson on types of accounts in accounting. In accounting, every account falls into one of two broad classifications and three nature-based types. Let's explore these classifications to better understand how accounts work in a business. The first classification is by financial statement element. There are five main elements: assets, liabilities, equity, revenue, and expenses. Assets are what the business owns or controls. Liabilities are what the business owes to others, and equity is the owner's claim, which equals assets minus liabilities. Revenue represents inflows from operations, while expenses are outflows or uses in operations. These five elements satisfy the fundamental accounting equation. Assets equals liabilities plus equity. This equation is the foundation of the double-entry accounting system, ensuring that both sides of the equation are always in balance. The second classification is by what's often called the golden rule nature. This divides accounts into three types: personal accounts, real accounts, and nominal accounts. Each type has its own rule for debits and credits, which helps accountants determine how to record transactions correctly. Let's start with personal accounts. These accounts relate to persons or entities and come in three forms: natural persons like individual customers, artificial persons like companies or banks, and representative persons like salary payable. The golden rule for personal accounts is debit the receiver, credit the giver. This means when someone receives something, their account is debited, and when someone gives something, their account is credited. Next, we have real accounts. These accounts represent assets, both tangible and intangible, that the business owns. Tangible assets include physical items like cash, machinery, and buildings. Intangible assets include non-physical items like patents and goodwill. The golden rule for real accounts is debit what comes in, credit what goes out. This means when an asset comes into the business, its account is debited, and when an asset leaves the business, its account is credited. Finally, we have nominal accounts. These accounts represent incomes, gains, expenses, and losses. Income and gains include items like service revenue and interest income. Expenses and losses include items like rent expense and utilities expense. The golden rule for nominal accounts is debit all expenses and losses, credit all incomes and gains. This means when the business incurs an expense, that account is debited, and when the business earns income, that account is credited. Let's look at some examples to better understand these rules. First, when you purchase equipment for $5,000 cash, this transaction involves two real accounts: equipment and cash. Equipment is a real account and something is coming in, so we debit equipment for $5,000. Cash is also a real account and something is going out, so we credit cash for $5,000. Let's look at another example. When you earn $1,200 of service revenue on account, this transaction involves a personal account, accounts receivable, and a nominal account, service revenue. Accounts receivable is a personal account, and the customer is the receiver of services, so we debit accounts receivable for $1,200. Service revenue is a nominal account representing income, so we credit service revenue for $1,200. Let's summarize what we've learned about types of accounts. Accounts are classified by financial statement element into assets, liabilities, equity, revenue, and expenses, which together satisfy the accounting equation. Assets equals liabilities plus equity. Accounts are also classified by their golden rule nature into personal accounts, where we debit the receiver, credit the giver; real accounts, where we debit what comes in, credit what goes out; and nominal accounts, where we debit all expenses and losses, credit all incomes and gains. Understanding these classifications and rules will help you correctly record any accounting transaction. Thanks for watching.